Hey guys. All content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. It's been a while since my last video. I sincerely apologize for my absence. If you read my community post, me and YouTube had a real scuffle, which of course ended at a serious disadvantage for me. I was stuck in a back and forth with them for longer than I expected. Though the outcome of it all screwed me over, the good news is that it shouldn't stop me from making more videos from here on out. Now that everything has been concluded with them, I am able to pump out content as usual, so everything will go back to normal. A lot has happened since our last video, and I will assume you guys saw Meta crashing and Apple continuing its reign as being the single stock to hold up this market. We have a couple of catalysts into this week, so before we go over any due diligence, let's look at the important events taking place. Monday we have a couple earning reports, but on Tuesday, we have day 1 of November's FOMC policy meeting. On Wednesday, outside earnings from the likes of Robinhood, CVS, Qualcomm and Novo, we have day 2 of FOMC policy meeting where we will get the final interest rate decision in a press conference. Thursday we have earnings from Starbucks, PayPal and Toyota, and on Friday we have earnings from other companies in the consumer credit report for September. In all honesty, the only real important thing right now is the interest rate decision by Powell, which we need to talk about in great length today. You guys know my stance on rate hikes. I strongly believe that the Fed is doing a good job in hiking them up, and I believe they should be much higher than they currently are. The only members of the economy who are pleading the Fed to pivot, which means to stop raising interest rates further and possibly reconsider its tightening policy, are the banks and other members of huge financial institutions, as well as the government, of course, because of political implications for the upcoming elections. Outside of these small albeit powerful group of individuals, everyone else agrees that inflation is out of control and that the Fed needs to maintain that same aggressive stance to fight it as they did when they printed endless money 2 years ago, which is actually what got us in this mess in the first place. The United States cannot afford to continue enacting policy because the current administration and BlackRock are getting hurt in their pockets. This is the stance I have on the issue, the one I have shared with you guys since last November of 2021. Today we are going to talk about the Fed and the different scenarios of what could happen if the Fed does pivot and if they don't. So, what are the chances of the Fed pivoting later into December? That's the question everyone has on their minds, the sole reason why the stock market has been so volatile and unpredictable these past weeks. Fed whisperer Nick Timiraos, who has an accurate record of forecasting Fed decisions, said the expectation that the next rate hike in November will be 75 basis points. We should note that it will take time for the cumulative effect of tighter monetary policy to work through the economy and to bring inflation down. The moderation in demand due to monetary policy tightening is only partly realized so far. What this means is that the economy tends to be very slow in how it changes, and that the effects of monetary policy will take time to be fully realized. After checking some leading indicators like the NFIB Small Business Outlook, the S&P Global US Composite PMI, the Philadelphia Fed Manufacturing Expected Conditions and the Consumer Sentiment Index, it is clear that the current data demonstrates we are registering multi-year lows in recessionary territory. Recent reports also showed that the U.S. economic downturn gathered significant momentum in October, while confidence in the outlook deteriorated sharply. The declines we have seen in the S&P Global Flash U.S. Manufacturing PMI was led by a downward lurch in services activity fueled by the rising costs of living and tightening financial conditions. There is, however, evidence and clear signs that weakening demand is helping to moderate the overall rate of inflation, which should continue to fall in the coming months as interest rates continue to rise. With these data points present in our minds, we now have an angle by which to interpret what Fed officials would set policy given their previous statements and comments on their sentiments about the economy. Fed officials would look at the data we just talked about and they would most likely feel uneasy. We know that the Fed's primordial mission is bringing inflation down, but inflation is incredibly stubborn right now. This would create a sense of urgency by which Fed officials could really be thinking of hiking rates up even higher than 87 basis points in the future. However, based on previous comments by Jerome Powell, we know that they continue to look at employment data and have been reluctant in the past to respond to policy, which limits how they can act without compromising their tarnished credibility. We have recently also heard some Fed officials say that the possibility of reducing their hikes to 50 basis points in December is on the table, which they will have to convince the markets that they are not backing off their goal of combating high inflation. In easier words, The Fed would have an issue if the pivot and lower rates because it could be perceived that they are not all that serious about fighting inflation, which could actually have markets lose significant value, and I am talking about trillions, as panic over this new stance comes out of nowhere. I think the best path for the Fed to lower hikes would be a successful set of CPI reports back to back where inflation numbers begin to ease off in a progressive manner. This would give a fair amount of credibility to any brute change in stance on hikes that would not be met with a market overreaction of panic sell-offs. The way I am personally interpreting what is happening overall is that the Fed is beginning to lay the groundwork for an eventual reversal on policy stance. How this will go about is hard to pinpoint because CPI data is not showing strong signs of improvement yet. Inflation is incredibly high and the worsening housing crisis is exacerbating any hope for a quick turnaround. But without looking at housing data, financial instability is rapidly growing at the moment, regardless of what SPY may gain on the daily, which is often overreacted by the corporate media and YouTube shills pumping news and stocks. In fact, let me give you the two biggest examples right now. First, we had that Bank of England crisis that took place about a month or so ago. The new Prime Minister's news of coming into office had a bit of a rally in the markets given that he does have a background in finance. With some changes made, the Bank of England is now set to commence the sale of gilt bonds on November 1st, which was actually today. We ought to see how this pans out in the future. But in other previous instances, like when the Fed offered the Swiss National Bank an initial $3.1 billion swap line, the effects of it were not that significant. This means that if further swap lines are required, it will signal to investors that financial stress is accelerating because the money being spent is just not enough to create the positive changes being needed. The Bank of Japan attempted to intervene in the FX markets to try to support their currency. It is estimated that they deployed more than $50 billion in USD reserves, but their efforts have not appeared to have had a successful impact because the yuan has continued to sell off. This speaks to poor confidence, which will lead to serious financial stress, which means markets could remain or increase in their volatility. But as I have said before, the best thing to keep your eyes close on at the yield curves. Yield curve inversion tends to precede a pause in rate hiking and the start of rate cuts. If we look through all the Fed stances dating back to the year 2000 and compare them to how we look now, it shows we are near a point stance pivot, but not there yet. As a result, I am quite confident that the Fed will at least maintain a 75 basis point rate for December, and depending on how the economy performs, we could see them pivoting next year. But how exactly will the Fed pivot though? How will that look like? Well, according to some market experts, the Fed will pivot in three main stages. We expect a third consecutive 75 basis point hike, which is affecting borrowing costs. Historically speaking, money still remains cheap and leverage still remains high in the system by comparison to other times. The Fed's book still remains under $9 trillion as well. So the first stage is just maintaining that third consecutive 75 basis points, then the second stage is reducing the rate hikes to 50 basis points, and after that it's about maintaining a neutralized policy. The Fed would then begin reversing course and becoming accommodative. The United States has already recorded 2 consecutive quarters of GDP, and I am sure politics is going to put pressure on them to pivot. However, I do want to warn each and every one of you watching this video, this is just the bullish case scenario for markets. Like I said, we are going to talk about what things would look like if the Fed pivots and if they don't, and this is the former explanation summarized after reading many articles and going through some interviews from Fed officials. However, the other side of the coin obviously has the Fed not pivoting until the end of 2023, which is the one I actually find more plausible given the circumstances that I am about to explain. Real simple and easy. The bearish case for the stock market is a hawkish Fed that remains stubborn through 2023, which in my opinion would be the best case scenario for stocks in the economy overall. The Fed won't pivot because inflation is persistent. We have had a full year full of bullish investors hoping for inflation to go down, but at best it has just remained barely unchanged in their height, and at their worst, they have shot up. Inflation clocked above expectation in September, and a pivot is an unlikely turn in the near future. Let's put some common sense and practicality into the equation. Though the economy is weak, it isn't really that much or coming as fast as people make it out to be. There are many indicators showing the consumer side actually is holding pretty well amid all the price increases, and the recent upside in GDP numbers show this. This means that the Fed has all the evidence and necessary points to declare that the United States can withhold high rates for another full year. This will show them stubborn and effective in their promise to bring down inflation whatever the time is needed without actually hurting markets or consumers too much to the point where they break off the system. Remember, the Fed wants to thread that careful line between too much and too little in fighting inflation. This is where housing data becomes more prevalent, because housing prices have begun to fall. The core personal consumption expenditures index won't show signs of easing for the next few months, which suggests that momentum of inflation is still very strong. That gives the Fed an actual excuse if questioned as to why they more continue being hawkish. Core inflation accelerated 6.6% as well. The labor market remains hot, another factor influencing the Fed's outlook on rate increases. Even though job openings have come down slightly, hiring is still robust, which will encourage the Fed to keep tightening until the labor market shows more signs of slowing down. The Fed is looking at America and they are saying, wow, even though we notice the pains that consumers are going through with these rate hikes, it is clear that the pains are not all that big a deal in the bigger realm of things, which gives us a green light into having more room to continue fighting inflation with high rate hikes, and I totally agree. Guys, outside of normal citizens which have 100% the right to complain about the high price of bread, the only others complaining about rate hikes are the big banks and politicians. They want that cheap money glitch that made them so wealthy to begin with, and they want it immediately. America is not yet ready to begin easing off the rate hikes when all the evidence suggests we are surviving the current rates pretty well. Wall Street is irrational to a fault, because they don't care about long term, they care about quarterly endings. They are run by parasites who can only see earning reports, that's it. They don't care about anything else, and we must stand together and acknowledge that appeasing these clowns will only lead to deteriorating economic circumstances that will continue to suffocate us long term. Do not listen to them when they tell you enough is enough and that we need a break because we still have plenty of room for higher rates. Let them hurt in their pockets a bit. Their 2-year rally in stocks was more than enough to cover the pains of this drawback. In my opinion, it's too early to pivot, but I just wanted to give you guys a solid read into the two scenarios that could play out beginning now in the event the Fed does begin to pivot. Not a lot has happened with meme stocks. GameStop began to rally hard, but Wall Street's favorite bully, the SEC, quickly intervened to halt the stock and ruin any upward mobilization that could affect the deep pockets of those poor shorters. Regardless, congrats to everyone buying and holding. I apologize for my absence. You all know I love making these videos. I was in an ugly fight with YouTube and had to withhold from making content while I was going through a back and forth that lasted longer than it should have. I took the L on it either ways, but am glad I am still here with you all. We've been having a good time trading in my Discord. If you are looking to make money trading penny stocks or options, feel free to come check us out. Link is in the comments and descriptions. These are some of our plays today. Though we took a couple losses, those that played options and stuck to my rules come out on top. We had 16 alerts on SPY and 14 ran their mark. We also played a penny stock which yielded great profits. If you seek to day trade with us, feel free to come check it out and tag me in a message if you have questions on Discord. Other than that, thank you all for remaining here with me and for watching my video in its entirety. Hope to see you on the next one. To the moon.